Good morning, everyone. Tim Nyland here. Today is Wednesday, January 27th, and this is our weekly strategy call for Zacks Professional Services. Each week, we focus in on what's moving the market. If you have a topic you'd like me to explore in a future video, please leave me a comment below. You can check out previous strategy calls on our channel, and you'll also find many more videos on investing and making the most of the Zacks Pro platforms. And don't forget to hit subscribe button below to make sure that you never miss any of our future calls. Today, we're going to talk about airline stocks. And more specifically, we're going to talk about some of the implied valuation issues you run into with analyzing such deep cyclical industries such as airlines. And the topic was triggered by an article that I saw in the Wall Street Journal just recently about how buying airline stocks takes a leap of faith. And obviously I read the article and dug into the research a little bit deeper. And obviously there's a lot more going on with the airlines than what's being talked about in the article, which is primarily the lack of bookings, which is more or less a given. So what we're going to do is we're going to explore the real leap of faith using the Zacks Valuation Model and looking at some of the charts in the Zacks research system. But first, what we're going to do is we're just going to pan through the Advisor Tools Quant Models tab, and this is available in the interactive desktop by simply entering in a ticker symbol up in the search bar. And when you do that, you'll get your menu options starting with key stats and quotes. And if you pan over to Quant Models, click on the tab, you can easily see the full display of all of our Zacks Quant Models, including the Zack Rank in the upper right side. So if you do this for some of the more predominant airlines operating in the United States, you'll see that we've got a variety of different Zacks ranks, primarily sells, strong sell, hold, and we're going to take a look at that. So if you look at the article that talked about the leap of faith and you look at the pace of vaccination, you can definitely tie the two together, right? So it's basically the COVID-19 induced lack of bookings in the short term that's been additionally clouded by the slow vaccine rollout and all of this uncertainty around these virus mutations that seem to be popping up. I don't necessarily want to say daily, but at least weekly. And if you read this particular article, again, this was within the last couple of days, Wall Street Journal, they're talking about some cities taking even more than a year to receive at least one shot. And so obviously, this issue of airline bookings could continue for some time. And this is the real unknown. And so if you look at this, Florida, this is 11 months. New York is about 13 months. They're talking about Illinois being 22 months, Pennsylvania being 15, California being more than 18. And it was interesting. I got an alert from my Wall Street Journal app last night, and it was talking about Joe Biden purchasing an additional, I believe it was 300 million vaccine doses, was the corrected headline. But at any rate, so there's definitely a driver here, and it appears to be the COVID-19 vaccine rollout and this virus mutation uncertainty. So in order to explore the valuation conundrum specifically, the first thing we need to do is basically create an airline composite. And I did this with roughly 9 stocks. You can see them up here on the screen. And I did that in the Zacks research system. And if you've seen any of my webinars, you'll know that I absolutely love this particular view in the research system. This is our price and earnings chart. It's literally my dashboard, if you will, my starting point for analysis, just to give me an idea of not only the price activity, but also scaled properly the earnings in a trailing 4 quarters adjusted manner relative to that price action. And from here, I can see many, many things, right? I can see very distinctly that we had this flat period of growth around the Great Recession. And then I can see this tremendous acceleration in growth. And again, it went and leveled off from 2015 to basically current. And I can also see that we've got this massive earnings trough that we're working through, even deeper than the earnings trough we had during the Great Recession. And because of these forecasts here, these are our unknowns. The idea is we've got this implied bid to valuation with the buy side, again, literally running the value of these airline stocks up some 25% or even more in some cases in the last couple months. against earnings that we just don't really know a whole lot about at this point. So the idea here is that we need to make note of these three very distinct stages of growth post-recession. And we're going to come back to this here in just a minute because it's very important. And again, recall that stage 2 here, this really rapid period of increased growth. Yes, there was obviously an increase in air travel in general, but a lot of that growth was, if you consider that the compounding of earnings growth was more of a one-time for new surcharges of luggage fees, seat choice, and even the ability to purchase higher levels of elite status. And that growth has since normalized out into stage 3. So when you're doing your long-term trend analysis, trying to determine how the buy side is going to be determining what level of growth to expect out of the airlines post-COVID, you've really got to consider how you're going to determine what the accurate level of growth would be to expect. And we're going to talk about that more here in just a second. So the first thing we're going to do is we're going to look at one of our favorite domestic carriers, which is Southwest Airlines. And notice that it currently has a Zacks rank of hold. And I'm going to go back to the prior screen because I want everybody to see how Southwest Airlines, the trend for growth and the trough that we're working through, it looks exactly the same as what we saw with the broader airlines composite, right? So again, all of these stocks more or less behaving the same from a valuation perspective. And this leap of faith, we need to explore a little bit more. What is the leap of faith? Obviously, it's being driven by bookings, but there's a lot more to it than that. So we've got to make some sense out of how the buy side is actually determining this leap of faith. This is the leap here. The fact that we've got estimates that aren't even going to really start normalizing until about 2023. And we've already run these stocks up significantly. Okay, as a matter of fact, if you draw the line back, we're already back to the end of 2019 in terms of price for Southwest, when Southwest was actually making $4.20 in earnings, and now they're forecast to make negative $6.57 for 2020, and not even break even in 2021. So you can see those estimates here. So again, this is the leap that we need to really, really determine what's going on in terms of valuation. And so when we come back to this whole concept of being able to determine a baseline growth period to use for our long-term growth expectations post-COVID, we really can't include this traumatic run-up here in stage 2. So we have to basically eliminate that from any sort of least squares annualized growth rate computation that we're going to come up with to determine what would be a reasonable normalized growth forecast to use post-COVID. So my recommendation is that we go with stage 3 because it's the most recent growth that we have that's normalized prior to COVID. And so what we're going to do is we're going to turn on the valuation model. And the first thing that you're going to see is the normalized earnings trend line in red. And so just to give everyone a quick background on ZVM, we haven't talked about it in quite some time. It's a 5-factor implied valuation model. It's driven 100% by consensus and user forecasts. This is a model that I've designed for Zacks. I've been involved with the creation of it for, again, over 25 years. This goes hand in hand with the earnings certain portfolio. And it's the earnings certain portfolio that we actually use as a market portfolio to calculate one of the factors in the valuation model inputs, specifically the equity risk premium. So you'll see the factors, the 5 factors here highlighted. 3 of them are company-specific factors. That's your EPS growth rate estimate coming in from the sell side. And the other one is going to be your F12M earnings fulcrum point. And the other one is going to be your company-specific risk factor. The 2 macro environmental factors that are applied equally to all stocks that you analyze with the valuation model is going to be the 10-year treasury, which is the risk-free rate, and obviously the equity risk premium. Keep in mind, it's the risk-free rate plus the equity risk premium plus the company-specific discount rate that all roll up to the total equity discount rate that's obviously used as the interest rate in the model itself. So the idea is that we need to first establish our growth expectation to use as a baseline. So what we're going to do is we're going to set the time period back to 5 years. And we're going to go up here and click this least squares button on the upper left to display the 5-year least squares growth rate. And again, this is where we actually model that normalized stage 3 that I've been referring to. And we can see that that's an annualized growth rate of about 3%. So if I'm a portfolio manager on the buy side and I'm looking through this trough, if I'm going to get back to COVID level valuations, I would expect that growth rate in earnings to look roughly about 3% once we get to this normalized phase. Notice that we've got this 97% run up for FY2 and then 1,822% run up for 2022. And we know that that's because the earnings are coming off of these really low comps and we're accelerating back to normalization. We cannot model this at all because it's too much growth and it's not what we would consider normal for long term. So the idea is our expectation is about 3%. And so using the Zacks valuation model, when you turn it on initially, you're going to have your F12M fulcrum all the way down at the very bottom of your screen because it's going to be at the bottom of the trough. And again, we don't want to model those earnings because these growth rates are not realistic, normalized long term. So what we need to do is we need to bring, by using the arrow tool here, bring your normalized earnings trend line all the way up to the point of normalization, which is forecast to be starting at roughly, the end of 2021. And we're being very conservative here, which you'll see in a minute. So the next thing we do, once we set that fulcrum point of earnings, and again, you're actually establishing your model EPS F12M here of 303. Once you bring that up to that level, you click on the market implied growth rate. It holds everything else constant here and solves for the actual market implied growth rate that sets the valuation model current return equal to 0. Once you do that, and that's this model return right here, once you do that, the model is in equilibrium, and effectively you've calculated a buy side bid to the implied valuation relative to these sell side forecasts. Okay, so right now we can see that the buy side bid for valuation in terms of growth for Southwest right now, based on today's pricing, is roughly 3%. And when we go back to the previous slide, we can see that least squares button that we clicked gave us for a 5-year least squares historic trend rate of 3% as well. That would tell us that this Zacks Rank hold perhaps is consistent with it being fairly valued, and that's basically the conclusion. So Southwest Airlines, the buy side, has made the leap of faith that these estimates are going to come in, and they're going to come in right along this trajectory. And we have been able to verify that from a market implied growth perspective, this leap of faith here, based on the fact that we've got this valuation model, we were able to calculate what the real market implied growth rate is relative to that historic expectation. So again, that's just a minimum for the buy side. Obviously, if it can grow in excess of that 3% market implied growth rate, and our expectation is for that to increase above 3%, if that is your expectation, I'm not saying that is our expectation, but if in fact that is your expectation, then perhaps Southwest Airlines would be a buy. That's more or less how you use the valuation model. But what we're doing today is we're basically determining what that market implied growth rate looks like and relative to the Zacks Rank. And that's very consistent here with Southwest Airlines. So we would call this fairly valued, and that Zacks Rank of a hold to be in line with what we're seeing from an implied valuation perspective. Okay. So the next thing we're going to do is we're going to take a look at Delta Airlines. And notice that Delta Airlines has a Zacks Rank of sell. And also notice we've got this similar trough. And I want everybody to pay attention to the depth and breadth of the trough. They're very consistent across these airline stocks in the entire industry, as we would expect. Okay. So the other thing I want everybody to notice is that we've got that same 3-stage growth that we need to consider for Delta Airlines. So we've got to determine how the buy side has arrived at pricing for Delta Airlines. And again, a lot of the buy side is looking to this stage 3 to determine what to expect post-COVID, right? So the idea is if we could just get back to pre-COVID levels, then the valuation would look like what? Okay, at a minimum. That's what the buy side is looking for right now. So this should sound familiar. This is exactly what we did for Southwest Airlines. So again, to establish the growth expectation right, that buy side is going to be looking for. We're going to solve for that stage 3 growth rate, and that's going to be the 5-year least squares growth rate of earnings. And all you need to do for that is just do a right mouse click on the valuation model screen and choose 5 years, and then go up here and click this least squares button in the upper left that I'm highlighting right here with my arrow. And it'll give you a least squares growth rate that's actually much higher than Southwest Airlines, actually clocking in at about 5.84. Okay, so a little different. Interesting that we've got a Zacks rank of sell here as well. So how do we reconcile this? It's very easy. So using the Zacks valuation model, again, we're bringing that normalized earnings trend line up to what we consider a normalized forecast trend start, which we could say would be the end of 2021. And again, we're making assumptions here. Okay, that's what the valuation model is. It's an exploratory tool. We can model any earnings point along this line. Okay, it doesn't have to be here. We could actually model out here. It doesn't matter. We're going to get very consistent results. So if you click on the market implied growth button again, we see something very different now. We actually see the buy side bid to valuation in terms of that long-term growth forecast to be negative 155. Okay, this has particular meaning because what this is telling us is that if in fact these are the real earnings, then we can we're basically bidding in a decline in growth. And we already know that the buy side is going to have an expectation of at least getting back to pre-COVID growth levels of that 5.84. So we've got to reconcile this difference in expectation versus what the market implied growth rate is right now based on these consensus forecasts. And notice that we've got a Zacks rank of sell here. So there's kind of our red flag. Okay. So the idea is now we're going to reconcile that gap between the market implied EPS growth of negative 1.55 and that historic 5-year least squares trend rate, which is going to be the buy side expectation post-COVID, right? The idea is, again, at a minimum, we just got to get back to the way Delta had grown over the prior period pre-COVID. And so if we hold all of the ZVM inputs, again, those 5 factors, we hold them all constant except the level of forecast EPS, because again, the depth and breadth of this trough is our unknown. So this level of fulcrum point is the real unknown. We already know that we've got a market implied, we've already got an expected growth rate of roughly 5.84. So the slope of this red line really can't change. That's the expectation from the buy side. We got to get back to pre-COVID levels. So we can't change the growth rate. We're going to keep all of the macro factors in play, risk-free rate, equity risk premium. We're going to keep everything in play except this fulcrum point, because again, if we're going to rebound faster, if this is going to be a U-shaped recovery, W-shaped, V-shaped, that's the question. So we're taking the current bid to valuation in terms of price, and now we're going to more or less solve for the level of earnings that gets our market implied growth rate back to 5.84%. So again, to do that, all we need to do is hit this down arrow to change the actual fulcrum level of earnings. And you can see that we've gone from a fulcrum point in the previous slide up here to now a fulcrum point down here. And so we've had, in fact, lowered the level of earnings. Isn't it interesting and ironic that the Zacks rank of a sell? All right. So the idea is we had to lower the earnings. Okay. And the Zacks rank is basically telling us that's coming. Well, the buy side is more or less there. They have already made the adjustment and the EPS estimates are going to follow. And the idea is, what does that trend look like, right? Is it going to continue to lower the bar for Delta? Because if we continue to lower the bar for Delta, that means the market implied growth expectation continues to rise, holding that valuation constant if we hold price constant. So again, we can reconcile these earnings relative to that growth expectation. So in conclusion, following up on what is that real leap of faith for the airline industry, so generally speaking, the Zacks rank confirms the sell-side analyst forecasts, accurately reflecting those COVID-induced lack of bookings that we saw in that article. The short-term forecasts are also being impacted, obviously, by that slow vaccine rollout, and as well as the virus mutation uncertainty. We know that travelers are just not buying airline tickets very far in advance, and that article highlights that as well. So the ZRS price and earnings trend chart, we also noted that for that 9-stock airline composite, it literally mirrors the trend for the bulk of the remaining member companies. And we looked at only Southwest Airlines and Delta, but you could literally go through the remainder of the list. They all look pretty much the same. The airline industry, we know after looking at the charts, has experienced 3 very well-defined stages of growth. And as a measure of conservatism, in order to establish our forecast growth baseline, we have to use the most recent 5-year time period. We can't use that stage 2 because those growth rates are likely not going to repeat themselves, because we had that massive run up in those one-time surcharges for such things as, luggage and seat choice and elite status. And I think even some airlines were charging to use the bathroom. They're going to have to continue to do that, obviously, to sustain even the growth that they have now. So again, when we looked at Southwest Airlines, the Zacks valuation, that bid to valuation was literally equal to the current consensus EPS forecast for normalized EPS fulcrum level as well as growth. And so that definitely more or less backed the Zacks Rank of hold. And then when we looked at Delta Airlines, we saw that the implied buy-side bid to valuation was actually less, right, than the current consensus EPS forecast would actually warrant for that normalized growth. And that would be consistent with a Zacks Rank of sell, because obviously the only way that we could bring that expectation back in line with that 5-year historic least squares growth rate was to actually lower those consensus estimates. So we are exploring, again, using the valuation model to explore where that fulcrum point of EPS is likely to go. The Zacks Rank says sell, and the valuation model actually mirrors that expectation. And so the likelihood that analysts are expected to continue to revise those estimates down in the short term remains high. And again, having that Zacks Rank of sell there is kind of validation to that, as well as using the valuation model. So we've got kind of two pieces of evidence pointing in that direction. So here's the real leap of faith, and in conclusion to the article that I was reading. So the real leap of faith is, what is the actual expected breadth and depth? And you can see I've got some highlights here. Really, really pay attention. It's not just the depth, but it's the breadth, right? We don't know how long this is really going to last. I mean, if we get some aggressive mutation that makes, the current vaccines maybe, less effective, they're already talking about having to have a booster now for the Moderna vaccine. I'm not sure, what the next 6 months brings. I don't think anybody knows. And so it's not just the depth, but it's the breadth. And it's those 2 factors that are really driving this trough that we see in earnings for the airlines. And you can see down here, I've got the airlines industry composite back on the screen, and I've just got the price and earnings chart itself. I cut the bottom panel out of it to fit it. So keep in mind that it's driving the EPS estimate levels for FY1 and FY2 and FY3. And if you think about that, that is actually impacting the growth trajectory. And that's the real critical one that the buy side is looking at. We're looking at how long it's going to take to get back to what we would call normalized growth. We can't value this hyper growth. What we can value is, and what the buy side is looking at, is when do we get back to normalized growth? So here's your leap. It's from here all the way to here, okay, for the airline industry overall. Some carriers are expected to get there a little faster than others, obviously. We do not know if we're going to have a V, a U, or a W-shaped recovery in the airline industry, all right? But we do know that we can use the Zacks Rank in conjunction with the valuation model, and this can literally be a guidepost for trying to reconcile these EPS forecasts with the buy-side implied expectations for growth. So again, the process is, take a look at what the buy-side would be looking at a minimum for normalized growth post-COVID by looking to what normalized growth was pre-COVID, and then solve for the current market implied valuation out of the valuation model and compare the two. And then if there's any differences, you reconcile that with the actual level of estimates. And based on those level of estimates, that is going to dictate what that growth trajectory is going to look like over FY1, FY2, and FY3. So a very, very straightforward process. If anybody is confused by any of this, please rewatch the video, reach out to me. More than happy to do any sort of one-on-one consult. We can hit any industry, we can hit any stock, it doesn't matter. Just let me know. So in conclusion, the Zacks Rank can be used to time your entry into the airline stocks, but just be aware of the underlying leap of faith, right? Use your composites if you're a Zacks Research subscriber. Know what's going on with the industry as a whole, and just be aware of what that leap of faith looks like. Okay. So that's about it for this week. If you find this video helpful, please hit the like button and be sure to subscribe for future videos. If you have any questions or requests, please leave a comment below or feel free to email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and my Twitter handle is @TimNyland. If you're interested in getting started with advisor tools or the research system or looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you very much for watching, and I'll talk to you again next week.